Hello, this is Brad Harvey with Harvey Investment Management with our third quarter 2023 update. Wow, did we end with a bit of a bang. At the end of the quarter, there's lots and lots of turmoil going on right now. In particular, the UAW is on strike. Looks like the government is going to shut down. What does all of this mean? Well, let's start with the strike. What's really behind this? Is it truly a labor dispute? Well, remember, our governmental policies have been favoring electric vehicles more and more. Lots of incentives to buy them. Unfortunately, 85% of lithium and battery creation for these plug-in electric vehicles comes from China. So we're sending them billions of dollars. At the same time, they require less labor hours to create. So the UAW wants to protect their jobs. That's certainly a valid concern. But unfortunately, we've been sending those jobs to China. More on that in a separate video. Some of the other themes for the third quarter seem to be pretty much the same. We have raising interest rates, we have higher inflation, we have lower productivity and growth. Not so surprising. What does this really mean? Well, first and foremost, remember, the fourth quarter tends to be a pretty good quarter. In fact, all in all, October is the second best performer in terms of markets over time. So let's run through the numbers in a little bit of detail. For the third quarter, the Dow Jones Industrial Average was down 2.62%, taking it to being just up 1.09% year to date. The S&P 500 was down 358, and the NASDAQ 100 was down 303. The Russell 3000, which is an all-cap index, was down 3.40, and the small-cap index takes out the basement in terms of broad indexes, down 5.54. The non-US markets, large caps, were down 4.89, while emerging markets were down 4.07. Bright spot, which may be a negative, 10-year Treasury yields were actually up 19.74%. The 10-year yield closing today at 4.573. That is certainly getting up there, higher than we've seen in a decade at least. Moving on, the broad-based bond indexes were down as well. The aggregate bond index down 4.11, the long treasury index down 1384, and the long zero index down 1957. Now, not to be so surprised, as interest rates have gone up, real estate hasn't done so well. The broad-based REIT index for the quarter was down 9.41%. Interestingly enough, as we're seeing inflation coming in more and more, the broad-based commodity index for the quarter was up 9.91%. Now, most of that has to do with oil. Crude oil for the quarter was up 28.83%, and that means it's up 12.89 year to date. While the dollar did improve a little bit in the third quarter, it was up 3.22%. Year to date, it's only up 2.54. So what that means is, as the dollar has gone up this year, if we're in the US and we're making foreign travel plans, those foreign travel plans are relatively cheaper as the dollar gets stronger. But remember, it means that travel to the US for non-US citizens makes it more expensive. So that certainly can drive economic behavior. Also keep in mind that as we go into the fourth quarter, it makes sense to take a look at your overall asset allocations. I am personally advocating that we trim cash a little bit and move that into equity or stock exposure. It certainly is down. It looks like next year is an election year, and therefore markets tend to do a little better. And I think it's a good time to be rebalancing. Maybe look at extending some maturities on your fixed income allocations as well. I know this is controversial and it's difficult because cash is now actually returning 5% or more, depending on the money fund that you're in. So this is Brad Harvey with Harvey Investment Management with our Quarter 3 2023 update.